We're sitting here at the end of 2025, and I'm watching something I've only seen a few times in my life and never on this scale. The largest technology companies in America are on track to pour about $400 billion into AI infrastructure in a single year. That is not a slip of the tongue or a misprint. $400 billion. Microsoft, Amazon, Google, Meta, the names everyone knows, are in an arms race to build data centers big enough to carpet Manhattan. They're buying every high-end chip they can find. They're signing contracts worth tens and hundreds of billions with companies that barely have a business model, let alone profits. And as I watch this unfold, I get a very familiar feeling in the pit of my stomach, the same feeling I had in 1999. You see, I'm 95 now. I've lived through more market cycles than most investors have birthdays. I've watched fashions come and go, manias rise and fall, heroes of one decade quietly vanish in the next. And through all of it, one simple rule has held up better than any fancy model Wall Street could design. When you see almost everyone running in the same direction at the same time, you should stop and turn around to see what might be chasing them, because more often than not, they are sprinting straight toward a cliff. Make no mistake, the AI revolution is real. I'm not a Luddite. The technology is astonishing. It will change industries, it will change jobs, it will change how we live. But what is happening in the stock market around AI right now? That is not long-term investing. That is speculation wearing a very expensive suit and speaking in very impressive jargon. And history has a cruel way of teaching the same lesson over and over. Speculation always gets punished eventually, no matter how smart, confident, or celebrated the people doing it think they are. Let me take you back to a time when I heard all of these promises before. In 1999, I was sitting in my office in Omaha reading about internet companies that had no profits, no tangible products, and in some cases no real plan beyond a buzzword and an IPO prospectus. They were being valued at levels that made old-fashioned investors like me wonder whether the numbers had lost contact with reality entirely. Pets.com had a sock puppet and a catchy Super Bowl ad. Webvan was going to reinvent grocery shopping. The Globe.com, founded by two college kids with $15,000, saw its stock jump more than 600% on the first day of trading. Nobody seemed to care that they had essentially zero profits and no proven business model. The story was all that mattered. And do you remember what people said about me back then? Warren has lost his touch. He doesn't understand the new economy. The old man in Omaha just doesn't get it anymore. I even had a young venture capitalist. He couldn't have been much older than 30. Lean across the table at a dinner party and tell me I was making the biggest mistake of my career by refusing to buy internet stocks. I still remember his words, "Warren, this time is different. The internet changes everything." Well, he was half right. The internet did change everything. It changed shopping, media, communication, research, nearly every corner of modern life. But what it did not change were the basic laws of economics and human nature. By 2002, the NASDAQ had fallen 78% from its peak. Many of the hottest names in 1999 had disappeared completely. That young VC, I later heard, went back to help run his father's car dealership. The new economy had suddenly become very old-fashioned. Fast forward to today, NVIDIA is now a $5 trillion company, $5 trillion for a chip manufacturer. OpenAI, which did not exist not that long ago, carries a valuation of roughly $500 billion, despite expecting something on the order of $13 billion in revenue in 2025. They have reportedly committed to spending around $300 billion with Oracle over 5 years. That is $60 billion a year in spending to support $13 billion in revenue. I had a 5th grade arithmetic teacher in Omaha who would look at those numbers and shake his head. What troubles me even more than the big numbers is the shape of the money flows, the circular financing. NVIDIA invests huge sums in OpenAI. OpenAI takes that cash and buys NVIDIA chips. Oracle races to build data centers for OpenAI, financed partly with money that depends on the success of OpenAI's still uncertain business model. Everybody books revenue, everybody shows growth, everybody feels brilliant. But underneath, a disturbingly familiar pattern starts to form. We saw this same movie in the late 1990 seconds with telecom and fiber optic networks, Global Crossing, Level 3, and a parade of other companies laid cable across oceans and continents at a frantic pace. They even loaned money to their own customers so those customers could buy more capacity. The customers then used that borrowed money to sign long-term contracts they had no real use for. Stock prices soared. Executives collected bonuses. Bankers collected fees. And for a little while, everyone looked like a genius. 4 years after that bubble burst, somewhere between 85 and 95% of the fiber sitting in the ground was still dark. Nobody was using it. Corning, the leading optical fiber producer, watched its stock plunge from $100 to roughly $1. I didn't invest in those companies, not because I was clever, but because I could not see a clear line between the money being spent and the money that would reliably come back in. That is my simple rule. If I can't understand how a business makes money over time, I pass. I've spent 70 years staying inside that circle of competence, and it has treated me fairly well. People sometimes ask, but Warren, didn't you miss out on the internet boom by doing that? Of course I did. I missed Amazon in the early days. I missed Google. I missed Microsoft during its first great run. They all became giants without my help, and you know what? I sleep just fine. For each Amazon that survived and thrived, there were hundreds of Pets.com-style disasters that burned through their investors' cash and vanished. The graveyard of dead .coms is filled with the names of people who thought they were too smart to lose. Here's something most people forget about bubbles. They grow out of a seed of truth. The underlying technology is often real and important. The internet was revolutionary. E-commerce did transform retail. Cloud computing did reshape business. The same is likely true of AI. The question for an investor is not, is this technology exciting? The question is, do these prices make any sense relative to what the business can earn over time? In early 2000, the NASDAQ reached a price-to-earnings ratio of around 200. That means investors were paying 200 years' worth of earnings for the privilege of owning those companies. Today, we're not quite there, but we're walking down the same road. The Shiller P divided by E ratio for the S&P 500 sits around 40, one of the highest readings in the last century and a half. And underneath that index, the picture is even more lopsided. Roughly 80% of the market's gains have been driven by a handful of large tech names. People call them the Magnificent Seven: NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla. Those 7 companies account for about 3/4 of the S&P 500's returns. That's not broad-based prosperity. That's a very tall, very narrow tower of optimism. Meanwhile, the real economy is quietly leaning on the same pillar. Recent research suggests that AI-related capital spending accounts for more than half of U.S. GDP growth in the first half of 2025. Think about that for a moment. Not manufacturing broadly, not energy, not small business formation, one technology trend. I have only seen this level of dependence on a single story twice before. In the Nifty 50 bubble of the early 1970 seconds and in the tech mania of the late 1990 seconds. Both episodes ended in tears. The venture capital world is marching to the same drum. Nearly 2/3 of all U.S. venture money in the first half of 2025 went into AI startups. At the peak of the dot-com bubble, internet deals were about 1/4 of VC activity. Today, we have more than 1,300 AI startups valued above $100 million and nearly 500 so-called unicorns claiming valuations over $1 billion. Most of them lose money. About 70% of funded AI companies are still burning cash with no clear path to profitability. Their valuations climb not because their economics improve, but because investors are terrified of missing the next big thing. Where I come from, we have a word for that. We call it gambling. My old partner and dear friend Charlie Munger, may he rest in peace, used to tell me, "Warren, it's the waiting that helps you as an investor, and a lot of people just can't stand to wait." Charlie understood something that the modern markets, with their flashing screens, options casinos, and social media cheerleaders, seem to have forgotten. The real money in stocks is made not by constant action, but by long periods of patient inaction, interrupted by rare moments of decisive buying when the odds finally tilt in your favor. Right now, I look at companies spending 22 to 30% of their revenue on capital expenditures, much of it AI infrastructure. That is about 3 times what regulated utilities typically spend on their physical networks, and utilities at least have predictable demand and steady cash flow. Meta is planning a single data center that will require more than 2 gigawatts of power, enough to run a small city, just to feed roughly 1.3 million NVIDIA GPUs. And I have to ask the same simple question I asked about fiber optics 25 years ago: for what exactly? To train models that may be obsolete in 2 years? To win a race where everyone is deploying billions just to stay even? To chase hypothetical future profits that nobody can calculate with any precision today? That is not disciplined capital allocation. That is speculation on steroids. Here is the uncomfortable arithmetic almost nobody wants to say out loud. For all of this spending to truly earn its keep, AI-related businesses probably need to generate something like $2 trillion in annual revenue by 2030. Today, total AI revenue is maybe around $20 billion, depending on how you count it. That implies a 100-fold increase in roughly 5 years, not 100%, 100 times. I have been investing since 1951. I have never seen an entire industry grow its revenue 100-fold in a few years while also delivering sustainable profits. That kind of expectation ignores gravity. Numbers, to me, are like stubborn old friends. They don't flatter you. They don't care about your narrative. They simply sit there insisting on being what they are. You can dress them up as adjusted EBITDA, AI-enhanced revenue, or whatever the phrase of the year happens to be, but at the end of the day, a business either earns more cash than it spends or it doesn't. When I look at AI right now, the story being sold and the numbers on the page do not match. Consider the 4 giants: Microsoft, Amazon, Google, and Meta. Together, they are projected to spend roughly $360+ billion on capital expenditures in their 2025 fiscal years. These are not scrappy startups testing an idea in a garage. These are some of the most profitable corporations in the history of capitalism, and yet they are spending like sailors who just found a casino on shore. Microsoft alone has guided to more than $120 billion in capital expenditure. Amazon is planning around $100 billion. Google has raised its own forecast from $75 to $80+ billion. Meta sits around $70 to $72 billion and has already promised similarly significant increases in 2026. When you translate all of that from billions and trillions into something more human, it comes down to this. These companies are changing their entire business models around one idea: that AI will justify all this spending. But when you examine the revenue side, the picture looks different. Microsoft recently said that its AI services had reached a $13 billion annual revenue run rate. That sounds impressive until you set it next to a $120 billion spending plan. If you spent $9 building a lemonade stand that only brings in $1 a year, you wouldn't call that a thriving business. You would call it a very expensive hobby and start asking hard questions. The defense you hear is always the same. This is about the future. We're investing ahead of demand. The payoff will come later. And sometimes that argument is valid, but there is a bright red line between rational long-term investment and blind speculation. The difference is whether you can reasonably estimate the return on that spending. During the dot-com era, Global Crossing invested about $15 billion to build its fiber network. The logic sounded bulletproof. Internet traffic was doubling every 100 days, so of course we needed more and more capacity. The problem is that every competitor saw the same charts and rushed to do the same thing. They overbuilt by something like 99%. When the music stopped, those $15 billion of assets were worth pennies on the dollar. Bondholders suffered, shareholders were wiped out. A lot of very clever people learned a very expensive lesson. Demand forecasts are often just wishful thinking dressed up in graphs. Today's AI construction boom is bigger, faster, and more leveraged than the telecom build-out ever was. Meta has arranged tens of billions of dollars in off-balance sheet financing. Others are quietly layering on debt, directly or indirectly, to fund these grand projects. Debt is a wonderful servant when things go well and a merciless executioner when they don't. It magnifies gains, but it also magnifies losses, and it never sleeps. I learned that in a much smaller way when I bought Berkshire Hathaway itself many decades ago for the wrong reasons. I was irritated with management. The stock was cheap, what I like to call a cigar butt, and I thought I could squeeze one more puff out of it. That emotional decision made out of pride probably cost Berkshire shareholders something like $200 billion in foregone opportunities over the years. I've called it the dumbest investment I ever made, and I meant it. Even people with good track records can make terrible choices when emotion overrides discipline. Right now, the dominant emotion in AI is not calm analysis. It is fear. Fear of missing out. Fear of being left behind. Fear that if you don't announce a multi-billion-dollar AI plan this quarter, the market will declare you obsolete. That is not a framework for rational decision-making. That is panic dressed up as strategy slides. OpenAI, the poster child of the AI boom, is reportedly on track to lose several $billion a year, despite widespread use of its products in a partnership with one of the richest companies on Earth. Its costs are so high that it must juggle raising prices, reducing usage, and searching for ever cheaper computing tricks just to keep the lights on. And again, OpenAI is not special in this regard. The entire AI startup landscape is built on the quiet assumption that eventually these models will become cheap enough and useful enough to shower everyone with profits. There is a phrase I've used for decades: eventually is not a business plan. Eventually often never comes. Back in the dot-com days, analysts used to obsess over a metric called the burn rate, how quickly a startup was burning through its cash. They would calculate the runway, how many months before the company literally ran out of money. What we see today is the same dynamic with AI companies, only with bigger numbers and deeper pockets behind them. The burn can last longer, but the underlying math has not changed. Spending more than you earn is not a sustainable long-term model, no matter how transformative the technology. Ray Dalio recently remarked that he sees clear signs of a bubble forming, but that bubbles rarely pop until monetary policy tightens meaningfully. He's right. Easy money fertilizes manias. When interest rates are low and credit is loose, people take risks they would never touch in normal times. But when rates rise again, or when growth slows and investors rediscover their interest in profits instead of promises, that's when you find out who has been swimming without a swimsuit. I suspect there are quite a few skinny dippers in the AI pool. Market concentration is another flashing red light on my dashboard. At the height of the dot-com bubble, The top 10 stocks in the S&P 500 made up about 27% of the index. Today, the top 10 names account for closer to 39%. That is not just concentration, that is fragility. When those few stocks stumble, and they will sooner or later, they will not simply drag down the tech sector. They will drag down index funds, retirement portfolios, pension plans, and college savings accounts all over the country. The average person thinks they are diversified because they own an index fund. What they really own is a gigantic bet on a small cluster of very expensive technology companies. And we already know how this kind of story tends to end. After the dot-com crash, it took the NASDAQ about 15 years to climb back to its March 2000 peak. Not 15 months, 15 years. An entire generation of investors learned the hard way that trees do not grow to the sky. Look at the gap between spending and revenue in AI today. By some estimates, Big Tech has invested around $560 billion in AI infrastructure over just 2 years. The combined AI-related revenue of companies like Microsoft, Meta, Tesla, Amazon, and Google adds up to maybe $35 billion. That is roughly $16 spent for each dollar of revenue. If you saw a corner store run that way, you would not call it a great business, you would call it a charity. Studies from institutions like MIT suggest that the vast majority of AI pilot projects, something on the order of 90+%, fail to produce meaningful business results despite tens of billions in investment. There is a canyon-sized gap between the marketing and the reality. Underneath all the spreadsheets and slide decks, the psychology is simple and very old. People are afraid of being left out of the next big thing. That same fear pushed investors into radio stocks in the 1,920 seconds, electronics in the 1,960 seconds, .coms in the 1,990 seconds, and real estate in the 2000s. In my 2000 shareholder letter, I compared investors to Cinderella at the ball. They know that staying too long means everything turns into pumpkins and mice, but they are terrified of leaving before the last dance. Today, the ballroom is filled with AI talk, the champagne is flowing, and everyone insists that this time the party really can go on forever. When people ask me for the secret to investing, they often expect something very complicated, some obscure formula. Instead, I give them 2 rules. Rule number 1, don't lose money. Rule number 2, never forget rule number 1. It sounds like a joke until you realize how brutal math becomes when you violate that principle. If you lose 50% of your capital, you need 100% gain just to get back to even. The more you swing at speculative pitches, the more likely you are to find yourself in that kind of hole. A researcher named Kai Wu looked at big capital expenditure booms throughout history. Railroads in the 1800s, automobiles in the early 1900s, radio, early electronics, the internet. In every case, the companies that aggressively ballooned their balance sheets with capital expenditure underperformed their more conservative peers by an average of 8.4% per year over the following decade. Year after year, the patient tortoises beat the frantic hares. When everyone races to build capacity at once, whether it is rail lines, fiber, or GPU clusters, they usually end up drowning in overcapacity. Prices fall, returns shrink. Investors hold the bag. The lesson my teacher Ben Graham drilled into me was the idea of a margin of safety. You insist on paying a price comfortably below what you think a business is worth, so that if things go somewhat wrong, and they usually do, you still have room to be okay. Today's AI valuations offer no margin of safety whatsoever. They assume nearly everything goes right: flawless execution, endless demand, few serious competitors, no technological disruption, and no serious recession. My experience tells me that in the real world, something always goes wrong. Sometimes everything goes wrong at once. Consider Cisco Systems. In March of 2000, Cisco was the darling of the internet era, the picks and shovels provider of the new digital gold rush. It had real products, strong sales, and genuine profits. That, at its peak, Cisco briefly became the most valuable company in the world with a market capitalization of about $555 billion. The stock traded at a price-to-sales ratio around 35 and a price-to-earnings ratio above 200. The story was that Cisco was different. This time, it was justified. Then the bubble burst. Cisco's stock fell about 86%. It survived as a business, but many investors never recovered. Even 25 years later, Cisco's share price still sits below its 2000 peak in inflation-adjusted terms. Imagine buying what you thought was a solid, dominant technology leader and still being underwater a quarter century later. Now look at NVIDIA. Is NVIDIA a remarkable company? Absolutely. Is it reshaping computing? Without question. Does it have real revenue and profits? Yes. But is it worth $5 trillion? That is the debate. For that valuation to be wise, many things must go almost perfectly for many years. AI demand must continue rising at a rapid pace. Competitors must fail to catch up. Pricing power must be preserved. Chip architectures must not be rapidly commoditized, and the global economy must avoid prolonged storms. That is a long list of ifs for any investor to bet on. Charlie liked to say, "All I want to know is where I'm going to die, so I'll never go there." In investing, overpaying is usually the place you go to die. You can buy the finest business in the world, but if you pay 10 times what it is sensibly worth, you have made a bad investment. The enthusiasm of the crowd does not alter that equation. Price matters. Valuation matters. They always have and they always will. Here is the part many people miss. You can be perfectly right about the importance of a technology and still lose money on the stocks tied to it if you pay too much. I underestimated the internet's impact. It reshaped the world even more than I imagined. But investors who bought the NASDAQ at the top in 2000, even though they were directionally correct that the internet would change everything, lost money for 15 long years. The stock market is, as Ben Graham wrote, a voting machine in the short run and a weighing machine in the long run. Right now, the votes are overwhelmingly in favor of AI, but eventually the market will weigh these companies. It will look at actual earnings, returns on invested capital, competitive dynamics, and the real utility of the products being sold. When that weighing happens, I suspect many of today's high flyers will feel much lighter than their current price tags. There is a game theory problem at work too. If Microsoft slows its AI spending, it worries about falling behind Google. If Google pauses, it worries about Amazon. If Amazon hesitates, it worries about Meta or a startup. So everyone keeps spending, even if deep down they suspect collectively they are overbuilding. Nobody wants to be the first to blink. But in markets, someone always blinks. Sometimes the catalyst is a recession. Sometimes it is higher interest rates. Sometimes it is simply investors saying, "Show me the money." I don't know what the trigger for this cycle will be. I don't know when it will come. What I do know, from 7 decades of watching human beings interact with money, is that no bubble has ever grown forever. They all burst. Gravity always reasserts itself. So where does that leave you and me? I am not saying AI is worthless. I am not saying these companies will all fail. I am saying that the prices currently being paid embed expectations that border on the impossible. And when you pay for perfection, you do not leave yourself much room for error. My approach today is the same as it was when I bought my first stock in 1942. I try to buy understandable businesses with durable advantages and honest management at prices that give me a margin of safety. Right now, most AI-linked stocks do not fit that description for me. That does not mean nobody will make money in them. It simply means that I am unwilling to bet the savings of millions of Berkshire shareholders on a story that relies on everything going right. Could I be wrong? Of course, This time could turn out differently. AI might grow so fast and so profitably that today's valuations look cheap in hindsight. That is always possible. But I am 95 years old, and I have been hearing this time is different for as long as I can remember. Every single time I have heard it, the basic laws of economics and the basic traits of human behavior eventually reappeared and reminded investors that gravity still works. There is one thing I know with absolute certainty. If you lose half your money, you must double what is left just to climb back to zero. That is arithmetic, not opinion. Because of that, my first job is not to chase every opportunity. My first job is to avoid permanent loss of capital. Right now, Berkshire is sitting on hundreds of billions of dollars in cash and short-term treasuries. We get criticized for it constantly. People say I am wasting an opportunity. They say I have grown timid. They suggest someone younger should be trusted with the cash. Maybe they are right about some of that, but I sleep well knowing that when this AI frenzy cools, and it will, we will have the ability to buy wonderful businesses at sensible prices from sellers who suddenly discover the importance of liquidity. That strategy is not glamorous. It will not trend on financial TikTok. It will not get me invited on every cable show. But it has worked for me across wars, recessions, bubbles, crashes, political tantrums, and technological revolutions. I see no reason to change it now just because the buzzword of the moment is artificial intelligence. The AI revolution is real. The AI bubble is real as well. Both statements can be true at the same time. Your responsibility as an investor is not to predict which chatbot or chip design will dominate the world. Your responsibility is to protect your capital and position yourself so that whatever happens, you can take advantage of opportunities instead of being forced to sell at the worst possible time. In a market obsessed with activity, I still prefer patience. In a world that worships prediction, I still prefer preparation. And in a moment when almost everyone is applauding the AI parade, I am more interested in checking whether anyone has noticed the missing clothes on the emperor. The stock market has always transferred wealth from the impatient to the patient. Right now, there is a lot of impatience on display and not a great deal of patience. I know which side of that trade I intend to be on. The AI boom will not last forever. I cannot tell you the day or the hour when sentiment will shift. But I can tell you that when we look back on 2025, a decade or two from now, we will probably shake our heads the same way we do when we look back on 1929 or 1999. We will marvel at how certain everybody felt. We will wonder how intelligent people convince themselves that trees grow to the sky. And we will see very clearly which investors preserved their capital, kept their discipline, and waited for sanity to return. That is where I hope to be standing, on solid ground with cash in hand, ready to buy when wonderful businesses are finally weighed rather than merely voted for. If you want my advice from one old investor to another, be careful out there. Be humble about what you do not know. Be skeptical when you hear that this time is different. And above all, be patient. In the long run, patience has a way of looking like genius. Remember that you never have to swing at every pitch the market throws across the plate again. Thank you for listening. And may you and your family stay safe, sensible, and prosperous in the years ahead.